The most dangerous moment in a retirement plan is normally not a market crash. It's actually when the first spouse passes away for a married couple. Because a plan built for two people suddenly has to support one survivor, one social security check disappears, but many fixed expenses remain the same. And the portfolio for that surviving spouse typically has to make up the difference for the rest of their life. And that right there is called survivor risk, sometimes called the first death problem, and is one of the bigger reasons a retirement plan can look fine on paper but becomes much weaker later on. Most couples naturally plan around the years that they expect to spend together. And that makes sense, but retirement is often lived in two phases. The first phase is the joint retirement phase, when both spouses are still alive, but when one passes away, you move into the survivor phase while only one spouse remains. And if your retirement plan only works in the first phase, then it's incomplete because the survivor may face a different income picture with different expenses, different healthcare needs, and a different level of portfolio pressure that they face year after year. I'm Jacob Euler, co-owner of Grand Summit Wealth Management. I work with high-income individuals, families, and business owners, and I've helped over 100 clients transition to retirement by coordinating Social Security, taxes, portfolio income, and long-term planning decisions. This channel is called 1% Wealth Secrets because strong retirement planning is not usually about one perfect decision. It's about understanding what happens when decisions interact over time. Let's start with the part that many couples don't fully understand. When both spouses are alive, the household may have two Social Security checks. And typically, that's supplemented with some combination of portfolio withdrawals, pension, business income, rental income, or other assets supporting your retirement plan. But when one spouse dies, the surviving spouse does not keep both Social Security checks. Usually, the lower check goes away and they keep the higher amount. While that's great that they can still keep the higher check, that can still create a major income drop because one of those checks has now disappeared. And how does that actually play out? Let's look at an example. Assume one spouse receives $3,600 a month in Social Security benefits. The other one receives $2,400 a month. So you have two good-sized Social Security benefits right there that adds up to a collective $6,000 per month they're getting in just Social Security benefits. A great foundation to the retirement plan. Now assume the spouse with the higher benefit passes away first. The surviving spouse does not continue receiving that full $6,000 amount. They receive the higher of the two checks, which is going to be that $3,600. And that's a drop of $2,400 a month or almost $30,000 per year right there. So that's the first problem. The second problem is that expenses normally don't fall by the same amount. Housing costs are usually mostly unchanged. Property taxes are probably mostly unchanged. Maybe your utility usage declines some, but it's not like it goes completely away. And different insurance costs, home maintenance, vehicle costs, and family support may continue. And that doesn't even get to the real boogeyman about healthcare costs and how those typically are very expensive and they become more and more important the later you get in life, especially if the surviving spouse ends up needing long-term care. And that long-term care piece is not a small issue. 70% of people end up needing some sort of long-term care services during their lifetime. And that could mean help at home, assisted living, nursing home care, or unpaid care from family members who may be willing. But still, those costs need to be considered, planned for, and accounted for. And as we all know, those costs keep going up and up every single year. So you put those pieces together, and the surviving spouse will normally have less guaranteed income, many of the same fixed expenses, and potentially higher healthcare costs the longer they live for. And that gap left by one Social Security check disappearing has to come from somewhere, and it typically is going to come from the portfolio. And that's where survivor risk becomes a real problem later in retirement. The portfolio has to do more work after it's already been supporting that family for years and years, perhaps. And that's why a retirement plan should not just answer, are we okay while both of us alive? It also needs to answer, how will this provide enough income once one spouse passes away? And so here's where Social Security claiming decisions become way more important than most people realize. A lot of people look at Social Security while both spouses are alive and ask, how much income will we receive together? And that question matters, but it's not enough. The better question that needs to be asked is, what will the surviving spouse keep once one of those Social Security checks disappears? And this matters most when one spouse has a larger Social Security benefit because that benefit will become the survivor benefit. So the decision about when the higher earning spouse claims Social Security may affect the surviving spouse for years or potentially even decades. So going back to that example we were looking at earlier, if the higher benefit was 3,600, that's what the surviving spouse would keep. But if the higher earning spouse delayed that benefit for a few years from 67 to 70, and now they receive a monthly benefit of 44.50 a month, that's an extra $850 a month of guaranteed income the survivor will continue to receive for the rest of their life. That's a difference of over $10,000 a year, which of course means over 20 years, that could be an additional $200,000 the surviving spouse gets in that guaranteed income. And that's a lot of money. That can make a big difference on not having to draw that extra 200,000 from the portfolio, and it allows it to continue to grow and support them for more years. But that doesn't mean delaying is automatically the right choice. It means the survivor benefit should be part of the analysis. Because a claiming decision that feels like a couple's income decision today can become a survivor income decision later that they don't have the ability to undo. This connects directly with longevity risk, which demands an answer to what if retirement lasts longer than you expect. Meanwhile, survivor risk will ask, what if the longer retirement is lived by only one spouse? And that combination matters. If the survivor lives a additional 15 or 20 years after the first spouse passes, then that survivor benefit is not a small chunk of the retirement planning decision. It becomes a much bigger deal. And that's why survivor planning should happen before the first death, not after. After one spouse is gone, those decisions that you had the ability to make, like when to claim Social Security, has already been made. There's fewer options and there's fewer ways to correct a plan that's under stress. The portfolio may already be smaller, healthcare needs may already be changing, and the survivor may not want to have the same amount of investment risk that may be necessary to allow their portfolio to grow enough to be able to keep meeting their income needs year after year. So the goal is not to predict who dies first. Instead, the goal is to test the plan under both outcomes. What happens if the higher benefit spouse passes away first? What happens if the lower benefit spouse dies first? And what happens if the survivor lives another 10, 15, or 20 years beyond the first spouse's lifetime? And as I also mentioned, what happens if healthcare and long-term care costs continue to rise during that period as we all expect them to continue to? Those questions are much more useful than just asking, when should we claim Social Security? Because Social Security is not just about the income when both spouses are alive, it can also be about protecting the spouse who lives longer. Now, to be clear, I'm not saying that every higher earning spouse should automatically delay their Social Security. There's a bunch of other factors that have to be considered: health, expected health care costs in the future, cash flow, portfolio strengths, the age gap between the spouses. All these factors come into play, and the survivor income needs are going to be based on how these interact. So to wrap this up, if you're married, widowed, divorced after a long marriage, or approaching retirement as a couple, survivor income demands your attention because a plan built only for the couple together may not withstand only one survivor. And if you've never looked at your retirement plan from the surviving spouse's perspective, that may be the missing angle you should now analyze. If you want help evaluating how Social Security, survivor benefits, portfolio income, long-term care needs, and income durability fit within your broader retirement plan, you can schedule an optional financial consultation using the link below. There's no obligation, it's simply a conversation to determine whether coordination would add value to your situation. So at this point, we've done 9 parts in our Social Security series. So now we're going to do one last video and tie everything together. Claiming age decisions, taxes, sequence of return risk, longevity risk, survivor risk, and retirement income coordination. How do these all fit within a broader retirement plan where Social Security is an important anchor, but only part of the plan? So make sure to stay tuned for that one. And if you thought this video was helpful, share it with someone who you think it could be very valuable for so that they don't make a decision that one spouse is left to live with. And we'll see you in the next one.